Welcome back, everyone, to your favorite podcast on Money Talks. As we get into these weeks on investing, looking at visual examples might help a bit. That's why I have put together a super cool blog, if you didn't know, for all of you with the link in the description below. So now, assuming that you have an investment account set up, yes, I'm talking about the last episode 6, where I talk about this. Now is the right time, the exciting part of picking investments that will hopefully make you some good money over the long term. Now the world is filled with infinite investment opportunities, some better than others, but today I'll be focusing on funds. First, we need to get two crucial concepts out of the way. The first one is passive investing. Passive investing is really the lazy way of investing for people who are, lazy, or either do not have much time to research stocks, real estate, or whatever form of investment. The other concept is robo-advisors. Despite what it sounds like, it doesn't have anything to do with robots in suits sitting behind a fancy wooden desk and giving investment advice. Rather, it's website and apps like Wealth Simple. Yes, it's two words just as it sounds, Wealth and then Simple. You can check it out online. This is a online service which asks you a few questions to understand your investment style and preference, and then handles the rest of the investment process for you as you add money to the account. This is basically passive investing on steroids. For the average person, I would highly recommend robo-advisors because the fees are lower than getting human advice from banks. Also, it's so convenient because everything is online or on a smartphone. But if you want to do your own research and passive investment and still be a passive investor and have passive investments, I recommend going through investing in ETFs or exchange traded funds for the long form. ETFs are these investments that track exchanges such as the Nasdaq or the Dow Jones on the New York Stock Exchange, basically mimicking the performance of these indexes. They can be purchased in any self-directed trading TFSAs or RRSPs. The good thing about these funds is that because there is little management required to make stock picks and such for these funds, the MER, which is the management expense ratio, on them is really low, so you end up saving a lot of money. The MER is this sort of annual fee on the total amount of money you have invested in the fund. The lower the MER, the more money you get to keep. The other great thing is that these funds offer you automatic diversification, which saves you from the extra risk of investing in individual company stocks, where the company is subject to all types of different market risks. Your fund, ETF in this case, has tens or maybe hundreds of stocks in them, so you're automatically diversified. So low cost and instant diversification makes passive investing very attractive. Even in the future, if you see yourself as an active investor who dabbles in stocks and real estate, passive investing through picking up some funds and putting your money to work is a great place to start and great practice for the future. Your own bank probably offers some passive investment funds. For example, I personally bank a lot with TD, and they have this thing called the E-Series funds. In my blog post, once again link is down below, I take you through a relatively detailed explanation of what to look for when looking through these funds, such as the risk ratio profile, MER figure, and historical performance. If you want to diversify even more, you can hold multiple funds in your TFSA and RRSP, along with stocks and any other sort of investments that you may wish. One important thing to remember when investing is that you do not have to put all your money into a single fund all at once. You can put your money in over time. This is known as dollar cost averaging, or DCA for short. I have attached a good few resources on my blog post about the power of dollar cost averaging versus lump sum investing. So that's it for now. Go out there, have a look at the blog post, pick up some funds, have some fun, and happy investing. Next week when we come back, I will go into stock picking and the qualitative factors to look out for.